So you know how Adam Jonas has been saying recently that Tesla stock's bear case scenario of $100 per share could be in play. I laughed it off. I shrugged it off because I was certain that these events would take place that would keep us from $100 per share and actually cause Tesla stock to rally, especially on earnings coming on April 23rd. Now, this is really twofold. There's the Tesla situation, in which we'll go over. There's the broad market situation, in which you're probably in for more downside there. That looks pretty certain. The AI stock bubble has started to collapse, and this week could be important for solidifying that AI bubble collapse. And if you're confused, we'll go over that here in this video. But the main point I'm trying to make is I'm a little bit less certain that we avoid $100 per share or something less than that, judging off of the latest actions that Tesla has made. I think it's important to remember that you can either be a company like Apple that has been, well, seeing declining revenue growth, declining growth in general, but you hold margins, so your stock does well. Or you can be a company that either, self-fulfilling or from an external force, have your growth slow down, in which that is Tesla. Tesla has not chosen to have their deliveries slow down. They've been, a consequence of the Fed. Well, Tesla can very much make the choice to preserve margins, to become more profitable. And unless we get some kind of big change from Tesla, that doesn't look like it's happening. Okay. Now, this could set you up for the long game, meaning that, with Tesla stock falling and Elon in war mode, whatever that means, that could set you up for longer term gains. But in the short term, it could get worse. And I want to go over that with you here in this video. So, the work is cut out for us. Hit the like button as well as subscribe to the channel. Let me know what you think about this information down below in the comment section. And let's just go ahead and get started. And there's really no easy way to put this, because I was under the assumption that Tesla was going to focus on margins from this point on, was going to focus on becoming more profitable. Because after all, if you are looking to commit to a factory in India at some point this year, if you're starting a new Megapack factory in Shanghai, if you're continuing to expand Giga Texas and Giga Nevada, as well as looking to build a factory in Mexico, let alone all of the R&D that Tesla is spending for full self-driving, that's a lot of money that Tesla needs to reinvest back into the business. If Tesla focuses more on profitability, then maybe they can do that and still keep their free cash flow. Maybe, in other words, all of that investment won't hit bottom line EPS too hard. Well, if you continue to cut prices, if you continue to put margins on the back burner, all of these investments will start to eat into profitability. And the recent action that we've seen from the Tesla team here in the last 12 hours or so, 16 hours or so, with them cutting prices of the Model Y specifically. They cut prices of the Model X as well as the Model S also, but those are not your big selling models, okay? Those don't hurt too much. But the Model Y, that's problematic. And Tesla just cut prices $2,000. Now, I'm going to get straight to the point here. Tesla's stock goes to $100 per share if you do not see clarity on this earnings call. If you have another earnings call like the last four, and Tesla obviously is not at this point going to commit to not cutting prices anymore. I thought it was a reasonable chance that Tesla was going to say, yeah, we're done with price cuts. But that's clearly not the case. That's clearly not what is going to be said. So that is off the table, okay? And if Wall Street starts to anticipate more price cuts, that's obviously not good. That's obviously not good for margins. Well, hopefully there's something to offset that. maybe this video is unfounded if the FSD take rate is higher and they cut costs somewhere and they can justify the $2,000 price reduction. I think that's going to be pretty hard to justify that. I think it's going to be net negative to margins. And in the near term, Wall Street's not going to like that. The other thing that gets Tesla stock to $100 per share is we're faced with a problem where Tesla's going to focus on robotaxi. Wall Street says, hey, you're not going to get the robotaxi up and operational for years. For years. And the Model 2 was going to fill the gap between now and then for Tesla's growth and hopefully have better margins in the meantime. And if Tesla does provide some kind of optimistic outlook for robotaxi, saying, hey, 2025, we should have robotaxis out on the road. We have a plan to set liability on ourselves and to put liability on Tesla for the robotaxis, and that should pave the way to get robotaxis in multiple cities in 2025. If that is what is said, great. Tesla stock's not going to $100. But if the Tesla team doesn't provide any clarity on when robotaxis could come, they don't provide any clarity on when the Model 2 becomes available for customers, if Tesla does not commit to preserving margins, you're going to $100. Okay. Now, gosh, that kind of seems like, I don't want to say the base case at this point, but it seems like Tesla's not going to commit to preserving margins. It seems like Tesla's probably not going to give a definitive timeline for at least consumer Model 2 deliveries. They're probably going to say, yeah, we're focusing on the robotaxi. The Model 2 for consumers is not canceled, but it's not coming anytime soon. Now, I think it all might hinge on the robotaxi. And that's not something Wall Street has given Tesla a lot of credit for in the past. So this becomes problematic. Now, we could have a structured earnings call where we walk away from it with a lot more answers than questions, or we could have another earnings call where we walk away from it with more questions than answers. Just a terrible earnings call again. Now, Tesla stock has fallen over 10% for earnings in a row. Momentum is to the downside. Wall Street, from their perspective, it's a lot easier to be short on Tesla, to be bearish on Tesla. And after this price cut, right before earnings, it becomes harder for me to be bullish on Tesla's earnings. I think we're kind of getting a preview of how things can go. And I want to still give Tesla the benefit of the doubt. Okay, Tesla's down 40% year to date. A lot of bad news is priced into the stock. In fact, it wouldn't surprise me if Tesla stock is not terrible next week, because you've fallen so much, you've priced in so much bad news. But then again, Tesla's earnings, they're not going to be great. Tesla's probably not going to give guidance. Tesla's probably going to say they will cut prices again if they need to. They're probably going to blame the Fed and say the Fed needs to start cutting rates, which is obviously true. They're probably going to say their R&D expenses are going higher, which they forecasted about $10 billion. It wouldn't surprise me if they raise that to like $12 billion. It wouldn't surprise me if they don't give definitive guidance on the robotaxi, but they say that's coming first, which Wall Street's not going to like that. They want definitive guidance at this point. And I'm just going to go ahead and play the clip from Dan Ives to let you get his opinion as an institutional investor. Because I've been very clear. I expected margins to be preserved. And if I'm wrong, well, Dan Ives might be correct here. And it could cause a re-rating in Tesla. And I think the way that Dan Ives puts this really puts it into a lot of perspective. So let's go ahead and run that clip.
Securities, Dan Ives is here at Post 9. We know that Tuesday is going to be a big day. You say the clock has struck midnight. And the line that stuck out to me, trading in the Model 2 for Robo would be a tragic gamble, in your opinion.
I think it would be a gamble that could maybe even define the future of Tesla next 3 to 5 years. And I think right now the big nervousness is Model 2. That's a key part of the growth. That's 50 to 60% of the incremental growth next 2 to 3 years. Robo-taxis, autonomous, that's not for another 5 to 6 years. And I'd say, look, we've seen over the last decade, we've been through a lot of white knuckle moments from Musk and Tesla. This is up there. And this has really been a Cinderella story that in the near term has really turned into a nightmare on Elm Street. It all starts next Tuesday. Needs to control the narrative, because if there's no adult in the room, there could be darker days ahead.
So if he really does say, we're going to play this long game, and it's going to come at the expense of the 2, you would re-rate?
That would be, if that happened, it would be a disaster of epic proportions. Because in the near term, and you've seen others throw in the white towel because of the fears of that and because of some of the stuff that's reported, that would really put a massive black hole or gap in the growth for the next few years. And if you look at the last sort of 2015, 2018, there were levers that Musk could pull and ultimately did pull. And that's why it's, you've seen the history. But this I'd say for the first time in 5, 6 years, long-term Tesla bulls are really calling, feels like they're about to hit the elevator if they don't hear what they want on Tuesday.
Why are analysts like you and investors so downbeat on the prospect of the robo-taxi future?
Bullish on robo-taxis, bullish on autonomy. The problem is this would be like Cook on May 2nd, coming out and being like, okay, iPhone 15. Now look, we're not going to have anything till iPhone 21, but trust us, thanks for being on the conference call. So that's the problem, is that we're bullish.
It's always worked for him before.
Exactly, and I think now the difference is you need a refresh. Competition comes from all angles, Game of Thrones that we're seeing in China, and the credibility for Musk has definitely been questioned because the last 2 conference calls we've talked about on the show, those have been train wreck horror shows. So it all comes down to clock struck midnight. Tuesday night, adult in the room needs to step up, navigate the story, and that's why we call it a fork in the road moment. We are still bullish on the long-term Tesla story, but this is a Category 5 storm, and the pilot on the plane can't be Ted Stryker.
But what do you, there's a lot of just analogies and stuff there, but what do you want to hear? Because the China competition is not in Tesla's control.
Yeah, you need to hear 4 things. 1, what's the growth strategy in China? How are we going to reverse the trend that we're seeing in mainland China, which has been, we'll call it 60, 70% of the growth, incremental growth story for Tesla.
How do they do that? Those cars are cheaper. They're nice. I saw them on the streets. I tested them. How are they going to reverse that kind of growth trend?
Hold prices, hold margins. We're going to basically bet on our brand, no different than what Apple has done, and I think many others, including Microsoft, depending on the products. But give the strategy there. What are the targets? And Sarah, they have to give guidance. What's the targets on growth realistically? What do margins look like? Where does it trough out at? AI, Musk, the 25% threat, recommit, keeping AI within Tesla, showing FSD, showing autonomy. That's been the problem here, is that if you had an adult in the room to navigate, I think 30% of the sell-off here has really been Musk driven, but it all comes down to, like, you could talk the talk, you gotta walk the walk.
So I guess that's one side of it. You could see a re-rating from Tesla by big money. And honestly, it's warranted if Tesla doesn't focus on profitability and it's just up in the air what's going to be Tesla's next growth driver. We can say FSD subscriptions. That would be awesome if the take rate does go high enough. We just don't know. If there's anything that could probably bail out Tesla stock, it could be that, but we're not going to have a lot of clarity on that most likely because you're still in the free trial period. So that's problematic. Now, I think if we were in some kind of bull market, if markets were doing well, then I think this would be less of a problem. But you're in fact starting to see the AI bubble popping. This is indeed one of the fastest sell-offs that you have seen in years. Now, the other fastest sell-off that I can look at here was this period where it was October really the last week of October before you started to rally. This was a pretty aggressive sell-off, and this has been like for just straight down, okay? And back here, you had a similar looking sell-off, but you have fallen hard and quick. That is mainly because of this AI trade. It says right here, people seem to think the AI trade would go up forever. It got crowded and now it is unwinding something fierce, says Dennis Dick, a proprietary trader at Triple D Trading. Yeah, don't say that to anyone else. He says, this is just a tech wreck, a rotation out of tech and the idea of tech as a safety trade. The AI trade in particular is unwinding. That's just really not great, okay? Just really not. It is not great. Now, why this happened is because Supermicro did not provide their guidance for their earnings when they confirmed their earnings day. Over the past 2 years, they have done that. Now they did not, presumably meaning that without that heads up that they're going to beat on earnings, they're probably going to miss on earnings. Now, you have seen ASML, TSMC also come out and have bad things to say about forward-looking guidance. Now, you also had ARM that received a downgrade on Friday by David O'Connor at PNB Paribas, and he downgraded the stock from outperform to neutral, and he kept his $100 price target, citing that there's not much room for an upside surprise coming on earnings. So you have this AI unwind that, I mean, if you just consider how much of this rally do you think was AI driven? Most of it, okay? Most of it. What happens next? Well, you probably unwind even further. Now, we have next week's earnings, and that will be very important for markets. That's for sure. Because you have some of your big tech names later into the week. You have, obviously, Tesla Tuesday after hours. You have Meta Wednesday after hours. Microsoft and Alphabet. Microsoft specifically and Google for your AI trade could be important. But you also have others like Lam Research, which actually did not fall as much as the other AI stocks, not even nearly as much as the other AI stocks last week. And if you do see an unwind to this whole AI trade, semiconductor trade, Lam Research could be vulnerable here. And I actually did put a trade out on Lam Research because they're the lagger here and maybe they catch up. If you guys want to see that trade, check it out. Link down below in the description of this video. So you have the AI trade faltering. And the expectation was that AI was going to cause demand and further productivity for many years to go, that we wouldn't see a slowdown in AI investment, in AI deployment for years, and that AI was going to boost companies' profitability. That's bullshit. If anything, the GPUs that Meta has been buying, that Microsoft or Google have been buying, or Tesla for that matter, have been net negative for bottom line earnings, not positive. These companies are not deploying products besides Tesla that are bringing in a lot of money. In fact, Tesla's really the only one that's bringing in a substantial amount of money based on their AI products, and that is with FSD. So investment's probably slowing down. Inventory's probably building up in AI. And these are things, or semiconductors, which are deemed your AI trades right now. These things are not going to be positive for our markets, and momentum is strong to the upside. It can also be very strong to the downside. Now, it would also not surprise me if Monday is a relatively okay day. Now, we'll see what happens over the weekend. There's going to be some downgrades. Different analysts are going to give their opinions on the situation. It wouldn't surprise me, though, if you do see a bounce. Because you're hitting 30 on the RSI, you're actually at 29.78. Every time you hit 30 in the past, you tend to bounce. You actually tend to bounce at like 31 on the RSI every time. This time, not. So you have seen a sharp move down. That's a pretty, I want to say, historic in that regard, but it's just been a fast down move. If we do get a bounce on Monday, reset that RSI a little bit, it's probably going to make way for lower prices to come down to maybe 395. Now, Nvidia is going to be a big test for our markets as well. Assuming earnings come in okay, not great, not terrible, you're probably going to fall some more. Stocks are priced for a really good earnings. That's just it. They're priced for really good earnings. 10% EPS growth is priced in for 2024. If that does not happen, You're screwed. Now, estimates are actually 5% for EPS growth in 2024, but they were just 10% to start the year last earnings. So I would argue the actual expectation is around 10%. If you come in there, that'll be great. If you don't, then you likely have a bigger problem on your hands. Okay. And again, NVIDIA will be very important. So I think you're going lower on the markets. Now, if NVIDIA has bad earnings towards the end of middle part of May, I believe. Well, I think they actually report on like May 22nd or something along those lines. May 23rd. If they have bad earnings, well, that's where you could see a really bad scenario. Markets back to October, November lows, if not even lower than that. It wouldn't surprise me if markets even went back into the low 300s for the NASDAQ as the AI trade just unwinds. There's not much of a reason to be bullish at that point. You also have 10-year treasury yields that are sitting at almost 5%, 4.6% or so, give or take. Yields have been very volatile recently. You're not getting that support. You're not getting support from inflation falling. You're not getting support from the Fed looking to cut rates anytime soon. It looks like if we do get cuts, they're going to be September, which is 5 months from now. Almost exactly 5 months from now, we're expecting the first cut. And if inflation comes in hot another month or two, you could be looking at hikes. Hikes could be the conversation. So I don't think Tesla's going to get support from the broad markets. Even if we do get a bounce on Monday, I think that does lead into more downside. Okay, that's just my opinion. I obviously could be wrong. Again, the RSI is very oversold now, and you tend to bounce here. Now, you fell in after hours, 0.2% on the NASDAQ. So, that obviously doesn't look good for Monday. And Wednesday is going to be important with Meta. That's going to affect your big tech names. And again, Meta, big tech, they're trading at all-time highs or close to. They're not priced for bad earnings, or they're not even priced for good earnings. They're priced for perfect earnings. And that's a dangerous scenario to be in. And that's why I've been bearish for a little while now, is because they're just priced for way too good of earnings. So quite problematic there as well. Now, with that said, how does this work into Tesla? Well, Tesla's been falling in a good market. Imagine what happens in a bad market. It gets ugly. It gets very, very ugly. $100 per share could be on the table. It could be. I hope we have a constructive earnings call. I really do. If we have a constructive earnings call with a competent Elon, then maybe it's not going to be as bad. I mean, I've listened to every earnings call for years, and the last 4 have been particularly bad. Way worse than before. If anything, before the last 4 earnings, you had a problem with Elon and the Tesla team just sounding too bullish. And it's quite the opposite now. They sound bearish. Their actions are bearish. Cutting prices, it's all bearish. And just very unorganized. If we do have just an organized, good earnings call with clarity, that's a good first step. But if we don't, if we get another earnings like we have seen and we continue to see the markets fall, and again, Tesla not committing to holding margins or holding profitability where it is, or if not improving it, my expectation was Tesla was going to improve profitability, say, hey, the Model 2 is coming in 2026, the Robo taxi is coming in the second half of 2025. If that happens, great, Tesla stock's not going to 100. But if we don't get clarity, as Dan Ives said, you could see a re-rating in Tesla and people hit the elevator. And that would mean some sharp downside from here. So let me know what you think about this information down below in the comment section. I know we're speculating quite a bit, but I tend to be one of the more bullish guys on Tesla, and I just want to give you guys a little bit of a heads up here that, if we get the same old earnings call, this time could be the dagger in the coffin for Tesla. It could mean, like Dan Ives said, there could be years of no growth for Tesla. Now, that's not my expectation. It's not. But that's how Wall Street could take it. And I think that opens up an opportunity. Clearly, you make money when you buy a stock. You don't make money when you sell a stock. If you buy a stock like Cisco at all-time highs in 1999, 2000, you still have not made money. If you bought Cisco at $2 before the whole rally in the dot-com bubble, you still made a lot of money. So it's more important when you buy a stock than when you sell a stock, as long as it's a quality long-term investment. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.